Okay, hi, this is Oz Sultan, and welcome to the Digital Assets in the Future of Finance panel. I'm joined here today by some laureates across the finance industry, and we're going to walk through a couple thought processes in terms of where we are with digital ledger technology and what the impacts are going to be, both from regulatory and I think systems and product perspectives over the course of the next couple of years. DOTUN, I wanted to start with one to you because the LSE has actually started a proof of concept process in leveraging a digital ledger to work on settlements. Where do you see, and then I'll open this up to the remainder of the panel, where do you see digital ledger technology inside of its role within exchanges and overall in the broader finance arena?
So it's a really good question. I mean, I think when you look at kind of some of the benefits of the technology, DLT, distributed ledger technology, has a lot of value in kind of two main areas that we see. So one being in its ability to discretely represent value, so any form of value, whether that be cash, as in the example of Bitcoin in its inception, but also moving on to, kind of intangible forms of value like other cryptocurrencies. But then specifically when we look at the kind of capital markets use cases, we're really talking about securities. So your traditional financial instruments represented in digital form. And then the other really interesting use case of the technology is it allows you to, through the smart contracts in their various guises, really build a suite of automations that can span across multiple organizations. So it's a way of kind of doing digital transformation, but rather than doing it within a single organization, you're able to kind of do that and spread it across the entire value chain. What it does require from a kind of build and deployment perspective is some real kind of collaboration and coordination to really materialize that, but it can reap benefits that kind of go out to and really improve the kind of ecosystem for everybody. In terms of kind of where we see the focus, digital assets being a really strong kind of space for that, and it's really looking across the entire end-to-end life cycle of these financial instruments. So everything from kind of primary markets issuance all the way through to safekeeping and the dematerialization to trading, not so much, but more so when you get into the kind of clearing and settlement. There's lots of interesting aspects there that DLT can solve for. And then specifically as you kind of build out beyond that and looking at kind of how you layer products and services onto the DLT network on top of those assets once they exist there, right? So you can get into the weeds of exploring use cases around asset servicing, data, and even more.
Excellent. Stephanie, what are your thoughts?
Well, I definitely think that DOTUN has touched on quite a lot of really good points, and stock exchanges all around the world are starting to really see the value in this technology. I mean, you will probably tell from my accent that originally I'm from Australia, and the ASX, so the Australian Stock Exchange, is actually the stock exchanges that are soon to launch the first industrial scale blockchain in financial services. So they really want to base all of their trading on the blockchain technology, and this is really because it does, increase transparency, but it also significantly shortens the transaction execution time. So a lot of people that may be listening to this and maybe don't sort of understand too much about the industry or how trading works, when you place a trade, say on an app or through your bank or broker, there is a difference between the price that you're seeing and then the price that you're executing at. So the speed at which the DLT actually executes will start to really smooth out a lot of those pricing fluctuations. So it really does sort of benefit the investor and bring a lot more transparency to the industry.
Mm-hmm. And Andreas?
Yes, I totally agree actually with my colleagues. And one thing actually, what was mentioned is the cooperation in between of the ecosystem partners. That means we need a legal framework inside of this community in order to work. And this is actually the best scenario to go, actually, to connect all the stakeholders into one infrastructure and share the same legal framework to work. And that gives a lot of synergy to the industry. Another thing, of course, it was mentioned, the Australian Stock Exchange. Yeah, they were the first, the first who started and who is already working on the DLT. And documents actually are open to other participants to share and to gain the knowledge actually what the Australian Stock Exchange gained during this experimentation. And moreover, to say actually, as I see this transformation, it's actually gives an interesting thing, so-called digital originals, that actually gives a lot of new perspective about what is the securities, what is the digital securities, and what is the digital assets. So such, I would say, prohibited instruments as, for example, bearers bonds and bearers shares actually could live in this ecosystem and could live in the proper way with the traceability, with the transparency, and all those things that in the current systems are so difficult to achieve. So yeah, basically lots of good things were said, and I agree with colleagues.
Trackability, traceability, the ability to leverage digital assets in the era of COVID are becoming, I think, increasingly important. What are your individual perspectives in terms of the status quo of the adoption of DLT or blockchain solutions in terms of structured financial products for both simple and derivative products? DOTUN?
Sure. Yeah, I think it's a tough nut to crack in many respects, and actually, where you see a lot of the challenges is kind of where a lot of these structured products are kind of hit up against the behemoth, which is essentially is regulation. So, when we look at ETFs, ETNs, there's a lot of activity going on, mostly across Europe. In the US, the SEC has not yet moved to authorize any kind of digitized ETNs or ETFs. But I think that there is the expectation that that can happen, and it will happen eventually. I think the biggest challenge as well with this is really one of kind of settlement and solving the depository aspect of it. So for those that aren't familiar, with securities generally, when they're listed on secondary markets, specifically regulated exchanges, there's a requirement across most jurisdictions, and a lot of this regulation falls out of the kind of IOSCO principles, which is kind of more kind of an international body that governs the underlying principles of financial markets infrastructure. And the requirement essentially says that if these assets are traded on a regulated exchange, they need to be settled by an authorized settlement entity, and generally those authorized settlement entities are central securities depositories. And so the challenge that you have today is for you to be able to list a digitized version of a security, whether that be an index or an ETF or even just a vanilla stock, on a regulated market, on an MTF, you need some CSD that has the capability to be able to settle that digital asset. And the challenge is where you have in the traditional world, the CSD holds the central record of ownership of who owns what stock at any given time, whereas within the context of digital asset technology or distributed ledger technology, the ledger essentially would represent that kind of golden source. So you need some way to marry the two. How do you take a CSD and bring kind of a DLT infrastructure into the mix, and then have some kind of harmony there that solves for that? So that's kind of one of the larger pieces.
I think that's fair. Stephanie, what are your thoughts, and what would you add to that?
I completely agree with DOTUN. Definitely, there's a lot of regulation that is changing, particularly related to structured products, ETFs and ETNs. I mean, one of the sort of main things that I touched on before is how the blockchain technology really does help to smooth out pricing fluctuations. And I say this because it's really relevant to PRIPS regulation, which is part of MiFID, and that's basically a regulation around these packaged investment products. And one of the sort of, I guess, considerations that has come out of PRIPS regulation is how people are reporting on their fees. So within a lot of these ETFs, you have different costs, one of which is the costs for executing. So a lot of people are actually, reporting on those costs at the time they send the trade into the market and not the time that it's actually executed. So this will also start to alleviate some of those problems. If we sort of look at, derivatives products and just general sort of securities, there are a lot of benefits, particularly in the derivatives markets. They're hard to value. The pricing fluctuation is one of those barriers. But also, when trading on over-the-counter markets, you do have counterparty risk. risks. And with use of blockchain and also smart contracts, we can alleviate some of those risks. So it is definitely a benefit of where the market is moving, and certainly as well, for more transparency and consumer protection, which is really where the regulation is pushing the industry anyway.
And Andreas? Andreas, you're muted.
Sorry. So I'm totally agree with this idea to bring the DLT to the CSD level. So actually, the vision would be an infrastructure built for CSDs, a shared network of the ledger, and it would bring this kind actually whether this golden record is issued and held as a blockchain or DLT asset. And actually, this kind of idea and this kind of infrastructure would allow to have maximum transparency and maximum efficiency when we're talking about the settlement and accounting of securities. So actually, it brings a lot of efficiency and lots of narrowing the scope of regulation itself, because lots of things that currently regulation is solving, you can trust to the system and trust to the infrastructure to solve. And yeah, that's the way to go.
So I would like to just add on the back of that, if I may. So I think it's really interesting to really consider the kind of regulation aspect of it, and it does really vary by jurisdiction. So if we look at Australia is a really interesting example. So in their securities regulation, they actually have a model whereby the CSD can essentially allow the legal register to be novated to another operator, and that other operator essentially being the exchange. So what that allows them to do is, if they have a DLT network that facilitates settlements, they can essentially run settlement intraday on the DLT network and then have essentially an end-of-day reconciliation that reconciles back to the CSD. So what that does is it allows you to build a piece of infrastructure that doesn't require you to bring the CSD essentially into the picture. The CSD just has to, let's say, synchronize itself with the DLT layer on a daily basis. So that's really it's an interesting model, and but it is very unique to that jurisdiction. I think this is where, when we're trying to solve for these issues, there's no one size fits all solution. There's no way to kind of solve it globally. It has to generally be done on a kind of regional basis.
I concur. What's interesting too is if you think about this from where big tech has been approaching it. So if you go back maybe about 30 years and you start looking at the large, multi-billion-dollar inter-country loans that are made to basically manage and settle debt, whether it's pension funds or whatnot has to be paid for. We used to have major issues with ERM bans, right, across Europe. And now what you're looking at, since it's a single currency, but multiple currencies inside of the European framework with the Nordic countries and several other Eastern European countries. IBM has started looking at leveraging Stellar in terms of a settlement protocol or a settlement token for reducing the fees in between countries. So from the context, looking at this from trading and looking at this from the exchange side is one side, but looking at this from the complexity of where this has to go from a banking perspective, we don't have these types of complexities in the United States as of yet, just in terms of trades with the loonie and with the peso. But from the European perspective, I find it a little bit more interesting. And what are your thoughts in terms of the DLT technologies, not just in relation to the banking arena, but how that's going to interplay inside of the exchange space? DOTUN, you want to start again?
Okay, happy to. Yeah, I mean, I think where it really starts to get interesting, I mean, when we look at kind of payments, and you raised a really good point on that, or when we consider kind of PVP payments, whether that's kind of wholesale or even on the retail side in many respects, one of the largest kind of sources of inefficiency, right, that we see across the market globally is the correspondent banking network, and whilst there are solutions such as Ripple that can solve for specific use cases within kind of, let's say a small subset of organizations. And what we really need to see is kind of more of a broader infrastructure play to really solve for that. And I think definitely that, the winds of change are kind of heading in that direction. So when we see, the announcement of Libra being kind of a private initiative to build a global payments infrastructure, leveraging essentially a private form of quote unquote cash. That essentially spurred of the regulators internationally to really start to explore some of the use cases around essentially providing DLT based or just purely an electronic system to facilitate more streamlined and efficient payments. And so what we're seeing now is a whole raft of central banks really starting to get into the weeds of exploring, what would it look like to build a central bank digital currency, a CBDC. Some of them are looking at DLT infrastructure to build that. Others are not. In the instance of China, as an example. But it's really trying to understand, how can we solve for some of these efficiencies? How can we build some infrastructure that allows cash to move much more freely in electronic form, for transactions to happen in seconds as opposed to days, right? And I think once you get that far, once that infrastructure is in place, it really does solve for a whole range of these specific problems in a much more generalized way than you'd get with these kind of individual use case by use case solutions. And also, you don't introduce the FX risk of bringing in an entirely new currency, whether that's a surrogate or a proxy or a synthetic, into the picture. So
that's fair. Stephanie, what would you add to that?
I mean, I definitely agree with DOTUN, and I think he's touched on a lot of really great points, particularly, Ripple and Libra, and also central banks. So, I mean, Ripple has done, a great job in terms of the Nostro accounts within banks. So a lot of banks have been, having bank accounts with different counterparties internationally for different currencies, and without the use of technology, they're not able to actually see the balance of those accounts in real time. So from a banking perspective, if you have, too much money that you're holding with another bank, then you're not able to use that to, lend out to mortgages or invest in other sort of assets. Whereas on the flip side, if you're not able to see that you're below a certain level that you're meant to have in that account, you're not actually getting that transparency on what sort of interest you're being charged in sort of real time to know whether or not you should top up that account or sort of draw it down to invest. So I think they've done a great job in terms of the transparency that they bring to those Nostro accounts and sort of that sector of the market, particularly Libra, which DOTUN already touched on. I think from a consumer perspective, there's a lack of, I guess, trust in cryptocurrencies or digital assets that we've really seen in the market. And there's sort of two parts to that. I think, Libra really did force a lot of central banks to really look at whether or not they introduce a cryptocurrency or a blockchain themselves or a digital currency. And I think, we really do need to see that trust, and that sort of plays into the liquidity issues that we're seeing sort of in this space in digital assets. And I think Libra as well, they already have the trust, being that they're, a technology built by Facebook, which, billions of people use every single day. So from that trust aspect, it really does start to bring, I guess, regulators to the fore to actually start to look at their own currencies, because, if you have too much widespread adoption of and that sort of technology and currency, there will be a lesser dependency on fiat currencies, which obviously is a massive impact on the global network and also central banks themselves. So I think, the world is really sort of moving to how they can actually create the transparency, the trust amongst the general populace, but also how they can still maintain that control and regulation.
And Andreas, what would you add to that?
Yeah, so one was mentioned, actually, CBDC and then central bank digital currencies. Actually, the central banks are getting on and experimenting with this concept, and this is actually a brilliant way to settle also securities and help the securities market to achieve the goals, to have the same layer or technology-based currency to settle on the same infrastructure is a beautiful idea, and I think this is worth to go with. And the second idea behind the central bank digital currencies is, again, as I said, the digital originals concept. That means that any kind of digital asset issued on the blockchain, it can be perceived actually as a digital original. That means digital cash, actual digital cash. And it is interesting also how the banks will push it. I'm waiting to see first examples. So I already heard mentioned the Chinese CBDC, but I think in Europe also will be some interesting projects to follow. So banks are also, like central banks are also talking about the retail and how to push this idea to the retail and how the retail users could achieve some efficiency using the CBDC currencies. So yeah.
So what's interesting to, I think, to kind of add to this is when we start looking at the consumer perspective. So in the United States and Spain and a few other places, Santander Bank has already put XRP into their consumer wallets that are available on your phone. And so what do you see in terms of, because I think there's a two-sided adoption curve here. There's the adoption curve that we're talking about for corporations, banks, financial institutions, exchanges, a lot of which is going to be predicated upon going through legislation, in some cases onerous legislation. And on the opposite side of this, there's the consumer adoption curve, which could be potentially faster. So what do you see in terms of, I would say, basically industry and regulatory hurdles for both sides of that? And this time, let's start with you, Andres. Sorry, there's just three of you.
Actually, the first thing is it to work is the trust. So the trust is the key, and I would go with the users and retail market, because it is much easier and to scale and much easier to go. And still, we can actually have our own ecosystem economies based and etc. But we have not to forget that there is a regulation behind every financial instrument and any financial industry participant. So we need to think it carefully, not to break the rules doing it. And the same regulations, for example, anti-money laundering and know your customer also applies to those user or retail industry-based, enterprise-based currencies. So lots of things to achieve and lots of regulations to follow. That's my opinion.
No, I think that makes sense.
I guess the regulation sort of curve and also the consumer curve really do sort of work together in parallel. And I think one of the sort of points that I mentioned briefly before is that Libra has really helped in terms of forcing some more adoption and sort of more progress in terms of regulation. And I think that's really needed. I mean, when the hype of sort of blockchain or Bitcoin, was really prevalent, it did also bring about the negative side of the hype, which is you get a lot of people doing the wrong things. You get, a lot of anonymity for money launderers. You had a lot of scams in terms of the ICO market. And so that has really, on one hand, depleted a lot of the trust that I guess came out of the hype of Bitcoin, and obviously the underlying technology of that is blockchain. So I think people really do see the benefit of blockchain, but there's still a lot of skepticism around digital assets because of all of the I guess lack of regulation that has really allowed for some of these things to occur, which has also financially impacted some people that have invested in ICOs, and also as well, I guess that comes back to consumer protection, particularly for retail investors. People that are not professional investors, that don't know all the sort of risks and ins and outs of investing. This is sort of where regulation does actually provide more trust and transparency, which is kind of in itself quite funny, because blockchain really came about because it wanted to create an ecosystem effectively away from regulators, and now for it to be really widely adopted, we need to bring in those regulations. So I think definitely they work in parallel. When we do have more companies like Facebook, more central banks that are actually producing their own digital assets, it really is going to start increasing that confidence, and then that is going to also in turn bring that sort of wider adoption. Because when you're launching a product, blockchain is sort of really the same thing. If your product, you have your early adopters, which are people that are more sort of, interested in taking those risks and trying new things. But in order to actually move to the mass market, you really need to get that widespread adoption, and that really will only come from trust, and that's really tied into regulation.
I think that's fair. And DOTUN, what would you add to that?
Yeah, I'll tackle the two sides separately. Looking at the kind of retail and then the institutional. And I think it's interesting as well, where we kind of explore that, regulation, yes, is one of the challenges, but also there are other challenges. So specifically on the retail side, where we saw, as was already mentioned in the ICO boom and bust, it was interesting because it taught us a lot of things. And one of the big things that it taught us was that, this whole kind of big tech and modern technology ethos or technology and innovation ethos of kind of move fast and break things sounds well and good, but when you're dealing with kind of use cases that in some ways are associated with value and kind of economics, it can be very dangerous when enough care and consideration hasn't been given to the risk that is posed to investors. And that was the biggest kind of signal that caused regulators to intervene, because they wanted to essentially protect the investors. And what you don't want in a retail space is to allow technology companies to build solutions, not take the necessary precautions, and then those solutions are exploited. And essentially, you have people's grandmas are losing their life savings and their pensions as a result of this. So there's definitely that angle. Another challenge that you see on the retail side specifically is just one of scale. Blockchain technology is very, very good, but it also has inherent challenges from a scalability standpoint. The mechanisms that enable consensus and that robustness of security within the context of open networks also actually restrict your ability to scale that technology really broadly. So that's one of the larger challenges that you're seeing some traction, even with the Libra model, with some of the more modern protocols like Radix DLT and some of the others. But it's a long road to travel. And when you're talking about, a currency for, let's say, an entire nation, look at, for example, a nation like India that has, over 1 billion people in the population. I mean, how many transactions would you expect them to make, in a day? And imagine the scale of infrastructure you'd need to support and facilitate that, and then, scale that out to a global scale. We're talking kind of infrastructure that is of a magnitude that probably, hasn't yet been conceived. So I think there are some big challenges there. On the regulation side, obviously, as was already mentioned, I think AML D5 is obviously a big factor, and I think it's really important, and just in terms of, again, economic stability, providing systemic stability against kind of risks of that nature, and then again protecting the end investors, and then just kind of moving onto the institutional side. I think trust is maybe less of an important factor, purely because the nature of regulated financial markets are such that there is a degree of semi-trust between most of these organizations. So, for example, the kind of cyber risks that you'd see on open networks just wouldn't exist in the context of financial markets, because it's all on private VPNs, that's essentially heavily resilient, cyber sector up to the wazoo, with very, very stringent policies around who can access what and how they can access it. So there are ways in which the trust element is kind of solved for outside of the technology. But I think some of the larger challenges, as we've already discussed, the kind of regulatory compliance side of things, the complexities involved in that, and also just the cost of infrastructure adoption, rolling out new technology in a heavily regulated market is very costly to do. Being able to integrate that within your existing infrastructure, to run it at scale, to be able to have the necessary security policies in place to be able to provide connectivity to nodes, whether they are on other networks or even public networks, can be very, very challenging. Being able to provide the right governance, even as Andreas mentioned, earlier in the discussion, around having the right legals in place, the right governance frameworks in place. You have real competitive incentives inherent in many of these organizations. So how do you solve for that when you're trying to bring these companies together and build, let's say, a consortium to govern a DLT network? It's very, very hard to do. And these are some of the nuanced challenges that we need to work through. So yeah, it will take time, but I think we'll see the landscape get there, I think, over time as it moves forward.
I think you raised some very interesting points in terms of the regulations, as well as the need to bring consortia together around these. But I want to pick up on something that Stephanie had alluded to. During the ICO boom, when we look at Australasia, they were particularly hit with bad ICOs, specifically because there's no consumer protections in place in, say, Korea and a few other countries. What do you what do you think needs to be shepherded in terms of the consumer regulatory environment over the course of the next 2 years? Simply because we have consumers who are trying to do things that professional investors have typically done, but inside of this new distributed digital economy, things are basically open to a lot more parties than would be open to previously. Stephanie, your thoughts?
Yeah, sure. So I definitely agree with what you said. This sort of landscape has really changed in the sense that, ICOs have really been enabled to or accessible to any type of investor. So, retail investors are now able to do things that professional investors were able to do. And I mean, I think that sort of ties into a liquidity issue. So with the ICOs, I mean, certainly back in 2018, more than 70% of ICOs were not listed on exchanges. So this means that if you I guess compare it to a traditional stock market, they're trading effectively not on an exchange, and this sort of brings up a few liquidity issues, and particularly for retail investors that don't sort of understand trading volumes, they don't understand wide spreads in terms of the bid ask of pricing, and also as well that sort of brings into account more, I guess, instability in the market. We've had, a lot of people that have wanted to get involved in ICOs, and particularly, involved in Bitcoin, because it's really made, to what a lot of people seem, overnight millionaires. So there's been this huge sort of upward curve in the initial phases of people retail investors investing in ICOs, and that has really quite a lot of issues. I mean, one of the biggest things is the volatility in the market. I mean, a lot of people sort of don't really understand that because there's, a lack of institutional investors, there's less stability. I mean, it's similar to capital markets in Asia that have less institutional investors, and so they are more volatile. And so I think retail investors don't really sort of understand these type of risks. When there's, also illiquidity in the market, it also sort of adds another risk of being able to sell out of your investment if you want to. It also as well really changes the dynamic of the pricing. So if you go and execute a trade, you might be paying more or paying far or selling it for such a loss because of those wide spreads, and because you don't sort of, I guess, activity in the market that you would if you had more institutional investors, or if you certainly had, I guess, a wider adoption for certain assets within that sort of digital asset space.
I think that's fair. Andreas, what would you add to that?
Yeah, so I would add actually that in order to make it a little bit rules, like to have rules and some certainty in this ICO and crowdsourcing, crowdfunding, I think that institutional players should come and facilitate this actually. For example, commercial banks, investment firms, brokers, financial brokers. It could help for those retail investors to understand the risk. And everybody knows actually that when you're coming to the bloodbath, there is a blood actually, and you can get lost in this battle. So yeah, first of all, education, a little rules, having rules, and having some, I would say, overseer or a bigger brother who could help you. For example, institutional players would be great to have, and it would be much easier to for the same startups and good projects to reach the goals and raise the money, raise the capital. So, yeah.
And DOTUN?
Yeah, I agree with everything that's been said so far. I mean, I would just add to that. I think, specifically when we're talking about cryptocurrencies and their growth and evolution in the kind of ecosystem today, specifically, we see the kind of DeFi, the growth of DeFi as well, which, providing kind of leverage services and lending services to retail investors. And it's interesting, obviously there's the security angle, which is a problem for a lot of retail investors. Theft is a big problem. There are literally billions of dollars worth of tokens stolen on an annual basis still. And so I think that's a problem that will need to be solved over time. And I think part of that is technology, and part of that is more stringent regulatory regimes around some of these execution venues, so some of the crypto exchanges. I think specifically looking at the exchanges, I think there's a lot more measures that can be kind of generally these are businesses that operate very similar to exchanges that you see in financial markets, and so I think you'll start to see a subset of some of the MiFID requirements at least make their way in that direction. So things like, for example, requiring these businesses to provide market surveillance tools to protect the markets against, the risks of manipulation, price manipulation, and then also, better measures to ensure that there is, price discovery and fairness around pricing specifically, as it's kind of been touched on already. So yeah, I think just starting to see more a more maturing of the ecosystem will help. And then I think maybe the final point I'd make is part of the challenge with this space, because there's less of a degree of scrutiny on businesses that are looking to ICO as compared with businesses that would be looking to IPO, then what you essentially see from an investor perspective is almost a sense of normalization, where every token listed on an exchange looks very similar to the next, and they have the same kind of structure, the same framework of information that's provided about these businesses. But there is a lack of transparency around, just the dynamics of some of these businesses, and many of them are very, very immature. So I think there's a dynamic there that needs some work and analysis in terms of how do you actually solve for that? How do you take businesses that in a more traditional context would be looked at as penny stocks or just assets that you wouldn't even want to list on an exchange, right? Because these businesses are just so risky. But you've essentially allowed them to tokenize their kind of intangible invest in some form and put it on a market so it looks very, very similar to an asset done by a much more mature business with real cash flow and real resilience underneath it. So yeah.
Excellent. I'd like to pick up on one piece of that. So after the financial crash of '29, that was actually one of the first times that we started putting actual diligence and processes in place for analyses of companies, and that's evolved over the course of 100 years. Now that we're facing a kind of a COVID bump, right, is what I'd call it, because we have seen a fair amount of market action there. What do you see as some of the guidelines that we should be establishing from an exchange perspective, from a bank perspective, and really what do you see that's needed from a regulatory perspective in order to kind of bring this into the 21st century? Because in a lot of cases, and we've seen this with the ICOs, your diligence might be reading a marketing white paper and not much more than that. And that was a lot of the danger in terms of where the losses were. And Stephanie, why don't we start with you?
Yeah, sure. So, I think you touched on a really good point in terms of the ICOs, and you're only really reading a white paper instead of, a lot more sort of information if you were listing or investing in an IPO. And so this is, I think sort of comes back to the point that we were sort of touching on before in terms of, retail investors are now gaining access to something that really only professional investors were able to access before in the traditional market. And I think that really sort of opens up to a lot of hurdles with the lack of knowledge. And this is where I think, a lot more regulation really needs to come into play, because there's a lot of companies that have been able to raise an incredible amount of money in ICOs, and really with nothing but a one-pager effectively. And I think in a sense, in some ways, it's beneficial. I mean, if you liken it to something like crowdfunding, for example, you're also targeting retail investors to back companies that they believe in. And I really do think that that is the future. And that's really actually how stock exchanges started, if you go back in history. But, I think when you're looking at crowdfunding as a comparison that's still targeting retail investors, you have a lot more sort of diligence and oversight, because crowdfunding platforms are typically regulated, right? So with ICOs, there's the lack of regulation and, lack of KYC of customers, which can open the company up to certain issues as well in terms of money laundering. So, I do think it is kind of a cyclical roll-on effect, and a lot of regulation would solve this, particularly as well those consumer protections. And, I think we are kind of moving into a space where retail investors are going to start to access more professional products. I mean, we're even starting to see that in the traditional space, a lot of fintechs that are starting up and giving, access to retail investors to more sophisticated products. And I don't necessarily think that's a bad thing. And certainly ICOs can be sort of, I guess, engage the interest of younger investors. But I do think that with technology also comes a lot of risks if there's not enough oversight to really protect people and also protect companies as well at the same time.
That's fair. Andreas, what would you add to that?
Yeah, so first of all, I would explain actually what is behind the ICO and how retail actually thinks, and this is some kind of interesting thing, because lots of retail investors who are participating in IPO process sees as a leftovers from the angel investors, from the seed investors, and etc. So those investors who got first to this good idea actually gets the bigger growth and bigger share of this pie actually. And the same rule actually applies to the gambling. For example, when people are gambling, they're trying their luck actually, and first of all, not to get burned by this gamble, you need just to be educated, not to overspend your money, not to overinvest, not to spend your last money on this bet actually. And still, I think ICO actually is also changing. The industry is changing, crypto community is changing and maturing. And actually, what was said, maturity, it's what's needed actually to this industry and to this particular cryptocurrency and ICO community that is still believing in this idea and going for the project that are doing ICO rather, or IAO, initial exchange offering. It's a next ICO step where crypto exchanges is facilitating this process. So yeah, everybody got a little burned by this crypto bubble, so-called, but everybody's still there and trying their luck.
And DOTUN, I'm going to add this one in just sort of the conversation. You guys are very much like NASDAQ in the sense that you do a lot of skunk works types investments and things. From your perspective, not just the regulatory side of this, not just the compliance side, and not just the diligence side, but how do you see that evolving inside of the trading space as well?
You're speaking in terms of what, just innovation, or in terms of the kind of issuance of assets?
Well, it's more of the diligence process that's going to be necessary so that we come up with standards, right? And I think that's the challenge that we have here.
Yes, yeah. I mean, when we're talking about regulated financial instruments, when you're talking about your equities or bonds, for example, corporate bonds, let's use as an example, there are some fairly rigorous regimes there. I mean, generally, you're either raising money as an issue in the money market, and there's conventions in the space that we see today, conventions around the processes that are involved, and a lot of that is driven by a lot of the larger essentially the investors, so the VC funds, the family offices, etc. But it is very fragmented, and there is a lot of divergence in terms of how those processes are managed. But generally, there is a suite of conventions. You would typically have a cornerstone investor, and then you'd have kind of follow-on investors, and the cornerstone investor would drive much of the due diligence, and they'd be very, very mature in that process. When you get to the secondary market side, where we're looking at specifically IPOs, that's when things are a lot more structured. So we look at, in the case of Europe, you have the prospectus directive, and each exchange has essentially their own rule book. around, when you list, you need to follow very strict regimes, and a lot of that is around, corporate governance, making sure you have a board in place, making sure that you have the right reporting structures in place to be able to report on financials and provide the necessary transparency to the market, and then essentially stringent controls over your business. So there's a lot already, I think, that exists, a lot of conventions that are very useful and are very helpful to kind of guide thinking. And when we kind of move away from that and look more at the kind of IEO space or ICO space, specifically with crypto assets, I think, again, with the kind of maturation of the landscape, you're going to see similar themes. You're going to see inspiration drawn from some of these regimes that exist today in the financial space. And the key thing here is these regimes exist for a reason, and it's all around trying to preserve and protect investors as well as issuers. When you can draw from some of those principles and incorporate some of those standards and formalities into the structures of, let's say IEOs, because I would imagine that's the way the landscape is going to go, consolidation and intermediation of issuance of these assets into bodies, venues or organizations that you can actually regulate, as opposed to every single issuer doing their own, then I can see that model growing and developing and building over time, and just building trust, I think, to Stephanie's point earlier. So,
and it looks like we're almost out of time, but I did want to throw one last question out, which is just generally germane to this, and then give you guys closing comments. In terms of where this is going with artificial intelligence and robo-advisory, right, tied to digital ledger technology solutions, what are your thoughts on that, and what are your perspectives for the market over the next year? DOTUN, do you want to start?
Yeah, I think it's interesting. I mean, there's a lot of growth and development of kind of, robo-advisory, robo-funds, algorithmic trading and automated trading has been a thing since forever, right? So, automation within that side of things isn't particularly new. I mean, yes, there is a new wave of, how can we leverage artificial intelligence to, better decision-making in that space, which is interesting, but ultimately it's to serve the same goal. I think where some of this stuff really does get interesting, it's really around, how do you, for businesses that are trading hedge funds or unit funds or trusts that have, a fairly broad portfolio of assets, and you're trying to build, trading strategies and methodologies that incorporate your ability to transact very, very quickly across a broad suite of assets. The interesting thing about the ability to have DLT in place is it allows you to digitize all of those assets, but also to do so in a way that it gives you access to them from top to bottom. So from the initial point of purchase, you can then trade those assets. You can essentially receive the pricing feeds, the execution fees from the exchange. You can then immediately rebalance your portfolios. You can then, have follow-on trades that are then issued as part of your strategy to other venues internationally, and you then get essentially this kind of web structure of automation that is much more broad and much more, let's say, lateral than you did in the past. And I think that's where things may start to get very, very interesting indeed.
Stephanie, what would you add to that?
Sure. So I think probably one of the things that I would add to that is on the sort of AI and robo-advisory space. I mean, if you look at sort of consumer trends on the traditional markets, capital markets, there's a lot of younger investors that are moving away from robo-advisors because they want to be able to have a level of control over their investments. And I think that's sort of where, education is really going to play a big role moving forward, not just in traditional markets, but particularly when it comes to digital assets and also blockchain, because there's a lot of people that really just don't know how it all works. And, the vast majority of people are not technical. For example, I'm not technical. So, I think there is very much a lack of understanding of how the technology works sort of on a wider spectrum. And also, I think it does sort of feed into the fact that there's a huge lack of financial literacy in both developed and developing markets alike. And so that's just in the traditional space. And now we're going to add something that's a lot more complex in terms of sort of digital assets into that mix of the lack of financial literacy that is already being experienced around the world. So, I do think in terms of artificial intelligence, I think that will play a significant role. But for the sheer fact that it does give a level of not only automation in some respects, but also guidance. I mean, if you sort of take a I guess, a non-financial person, and you give them sort of guidance with artificial intelligence, it does actually sort of reduce that barrier to entry. It gives them a very simple way to actually understand and guide them through the process. And so I think with the combination of artificial intelligence and DLT, it does sort of really sort of shape a great user experience for particularly younger investors that are coming through, that really are the early adopters to new technologies, and also a significant portion of our population now. And certainly, as younger generations come through, they're the ones that are always the early adopters to new technologies. And so I think that as we sort of roll through those generations, we're going to see a wider adoption and a lot more sort of education around people taking control of their financial well-being, particularly with the technology and the digitization, which is more, I guess, fluent with people that are younger.
Yeah, I think that's a very valid point. And also, since we have these shifting mores these days in terms of what perspectives should be leveraged around green investment, clean investment, and so forth. And Andreas,
Definitely.
Your thoughts?
Yeah, to add up, actually, it gives two perspectives. So first perspective is also having artificial intelligence and blockchain-based information that you can drill down from top till down. You actually can have beautiful tools for anti-money laundering or surveillance teams that can identify the bad actors, malicious trading, lots of things that actually should not happen on the market. So not only from the user perspective for retail or investor perspective, but also for intelligence units. It can give lots of information, lots of tools to prohibit the malicious behavior. The second point is maybe not the artificial intelligence, but having the digital assets issued on the blockchain gives you the possibility to have smart securities or smart assets that can execute something behind. It can have a logic put at the protocol level. For example, the dividend payments or some kind of other triggers that is triggered automatically when the logic says. So lots of things and lots of automation could be achieved using the technology.
And then final and closing thoughts. Stephanie, let's start with you.
I think in terms of final and closing thoughts, definitely I think there's more education that needs to be in this space, whether it's sort of, traditionally or certainly now as the market is shifting to digital assets. I definitely think education is really going to help adoption, and also definitely regulation, which I know we've touched on a lot. I think also as well from sort of the point that sort of Andreas was making was, there is a lot of things that sort of need to change, and there's a lot of, I guess, infrastructure that also needs to change to really be able to, I guess, make this a more seamless process. And I think as that infrastructure starts to change, we will see, from a user perspective, better quality of technology, better pricing, more market stability. And so the combination of that, I think, will really enable there to be a more widespread adoption, and definitely the benefits will be seen out of where the market is already shifting.
Andreas?
Yeah, adoption is coming. You want it or not, actually. We experience a lot of positive moves from the enterprises and the institutional players who are actually currently experimenting with the technology, what you can achieve, how could you scale it, how could you cooperate, for example, what legal framework should be to cooperate with other participants, even the same market players that you're competing against. So, and education, of course, education is the key. Usability problems, actually, that also blockchain and DLT has with crypto keys and how you should behave with those keys and how you should store the keys, because never the blockchain was hacked or something hacked the blockchain. Actually, the users keeping the keys were hacked or crypto exchanges were hacked. So from perspective of security, it's one of the most secure infrastructures in the world currently. But still, adoption is coming, and yeah, it's slow, like any kind of technology. But lots of players are like experimenting and playing behind the curtain, and lots of solutions is coming out every day. Lots of positive news. For example, the European Central Bank has a working group working on a CBDC model and CBDC concept. So there are lots of associations, European Union and European Parliament initiatives that are also working on the frameworks and regulatory frameworks. Yeah, so we just need a time.
Exactly. And DOTUN, final thoughts, closing out.
Yeah, I would agree with, I think, everything we've said so far. I mean, I think, the outlook is there in the sense that, digital securities represents a really interesting and potentially game-changing innovation in the financial market space. I think over the next kind of 3 to 5 years, you're going to start to see, all of the groundwork laid in terms of transforming kind of your base level infrastructure. And I'm talking kind of FMI, I'm talking CBDCs, I'm talking end-to-end digitization of, the life cycle of the instruments, all the way from, primary markets all the way through to trading, clearing, and settlement. And I think once you have that in place, once the core has been laid and all the hard work has been done in accordance with regulation across the various jurisdictions, and then tying all of that infrastructure together, you're going to start to see innovation really take hold and really kind of accelerate. And that's where, you're going to see a real growth and explosion in, innovation that's driven then by fintechs in partnership with some of these larger institutional players. So I think it's interesting, it's exciting, but again, it will take time. It's not going to be a quick shift.
So just in closing thoughts, the same way that we had the ability to create massive digital products in the 1920s with the changes in regulation and the changes to funds in the 70s, we now have this massive opportunity, I think, going into 2021, that's going to be the coupling of not just those factors, but all of this technology, which is almost running like a .com boom at the same time, parallel path. It's an interesting market that we're moving into. I'd like to thank my esteemed panel for their time. And, if you need to reach out to anyone on the panel, they're available through LinkedIn. And thank you, everyone, for your time.
Thanks for having us.
Thanks for having us.